What I have for you this week is a rather mysterious and yet not so mysterious case. As you can see here, I write BAT, British American Tobacco. It is a case from the Netherlands, the lower court, which at the request of the taxpayer has been completely anonymized, but I will explain why we talk about BAT. First of all, it is in the market, the rumor that this is a British American tax case, and let's see what was going on here. This is the BAT annual report for 2021. You can see that page 275 says the Netherlands and Dutch tax authorities issued a number of assessments on various issues across the years 2003 through 16 in relation to various intragroup transactions. The assessments amount to an aggregate net liability of £1,146 million covering tax, interest and penalties. The group appealed the assessment in full. The group believes that the companies have meritorious defenses in law and fact in each of the above matters and intends to pursue each dispute. The group does not consider it appropriate to make a provision for these amounts. And they lost in any case before the lower court and needs to pay 125 million euros. So let's see what the case is about. It is a complex case. It is 3 cases in one. We'll only look at one of the aspects, and it starts with this. We have the UK and the British American Tobacco PLC, which is the listed company, which the court refers to as Company 2. Then we've got 3 companies in the Netherlands for what concerns the factoring part of this case. There is the Dutch parent company, and then there is Factor Client 1, which is called Company 5, and Factor Client 2, which is called Company 6, and they are all in a tax consolidated group, which means that for Dutch tax purposes, they basically taxed as one taxpayer. And if we look at the facts of the case, Partnership 4 is a company number 4, which provided factoring services to NLCO 5 and NLCO 6 that you can see here on your left. And NLCO 5 paid risk fees of 2.5 million euros per annum to Partnership 4. And Partnership 4 is in country 2, and it is a FOF, a vennootschap onder firma, which under Dutch law in any case would be a tax transparent partnership where the partners are jointly and severally liable. Next fact, there was obviously the factoring transactions with Company 4, 5 and 6, and then the next fact is that Company 4 had an excess profit ruling exempting 80% of its profits, of its factoring profits. Now we'll see some different numbers here. I'm not sure whether it was 80% or whether it was 92%, but in any case, the court took as fact that a significant part of Company 4's income was not taxed in country 2, and the excess profit rulings worked as follows. A taxpayer would go to the tax authorities and say, well, look, we got this business from the group. We're making a tremendous profit from this business. The profit that we make is not at arm's length because third parties would have made much less profit. I believe in the case of BAT, the argument was because there was not the huge group synergies and all those advantages. Therefore, tax authorities, do you agree that if you're going to adjust us transfer pricing wise for earning too little profit, you should also adjust us for earning too much profit, and therefore you should only tax 20% of our profits, because that is what an arm's length profit would have been if we were a third party, and then you need to exempt the other 80 or 92%. And the tax authorities of country 2 apparently went along with this request. The next fact was that there was a risk relating to debtor company number 8, which was a third party, I believe, and which company number 4 simply said, you know what, this debtor is too risky, we will not include the factoring for them. And then the factoring, just to be very clear here, concerned the company 4 paying company 5 and 6 when it received the money from the debtors, or at the latest at the due date of the payments. But company 4 could say, if you have a debtor on which you have a receivable of more than 3 million euros, we can throw that debtor out. And this is what happened with debtor number 8. And then what happened was that NLCO 5 in 2007 concluded a third-party insurance with third-party insurance company number 10 here, initially with the idea of covering only debtor co 8's risk. But company number 10 said, you know what, if you want to insure debtor co 8, you got to insure all your debtors with us. You cannot just pick one, because when we obviously then can charge you a premium over all your debtors, which are much bigger than just your one debtor, and then we prepare to take the risk of that one debtor going in default. And there were certain caps in place, but this was the whole idea behind this. The issue was that BAT only paid 0.4 million, I think, for 480,000 euros per year for the insurance with a third party, and not the 2.5 billion that it was paying to company number 4. And this is what triggered the Dutch tax authorities. And then they had an external company number 7, which I assume is an advisor. It might even have been PwC, and I'll explain why in a moment, that determined that the company 10 insurance premiums did not constitute a reliable internal comparable, and that the company number 4 factoring service fee was at arm's length. So even though company number 5 paid only 438,000 euros to company number 10 for covering its debtors' risk, it was at arm's length that it paid 2.5 million to company number 4, is what the argument was by advisor number 7. And that conclusion was reiterated by company number 11 a couple of years later, with reference to the groundwork done by company number 7. So this was the facts. These were the facts. And then the Dutch authorities came onto this case through Belgium newspapers on LuxLeaks, the big tax scandal that was opened by this consortium of journalists. And this is interesting, right? This is the Dutch authorities reading Belgian newspapers and then going after Dutch taxpayers. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses on that. So what happened here? The court decision itself says that the taxpayer, the tax authorities started a audit in 2015 about the arm's length character of the paid factoring fees, and this was done because of publications in the media, among other 2 newspaper articles in Belgium, or country 2 as it's called here, on the 6th of November 2014, through which the Dutch tax authorities became aware of this excess profit ruling with Belgium. And if we just have a look at what happened around here, right? So the newspapers published the LuxLeaks results, which mentioned British American tobacco and favorable rulings in Luxembourg. It also published the rulings that PwC concluded for British American tobacco in Belgium about a permanent establishment for company number 4 in Luxembourg and how to tax that going forward, right? So this was a 2009 Luxembourg ruling request. It starts by introducing company number 4, and it says on 16 October 85, British American Tobacco established a coordination center in Belgium, British American Tobacco Coordination Center, VOF. This is this Vennootschap onder Firma that I reported, which is a partnership, which benefited from the status of coordination center up to 31 December 2005. I think that's when they got rid of the coordination centers under pressure of EU law. And then BATCC carries out financing and non-recourse factoring activities for 12 entities located in Europe, including Belgium, France, the Netherlands, Switzerland, and Spain. And then it goes on in point 8 to describe how these how the ruling in Luxembourg, in Belgium worked, right? BATCC's taxable basis for Belgium tax purposes is reduced by a certain percentage of additional profits. So this is the excess profit ruling, attributable to group synergies. This is what we referred to before. This percentage has been determined further to a Belgian benchmark study undertaken in 2005 on European companies performing factoring activities similar to the ones performed by BATCC. This percentage corresponds to 92% of the factoring fees less the cost of factoring. Now, so only 8% of the factoring risk factoring income was taxed in Belgium, and I think the court talks about 80% because there was an additional fee for handling the administration of all the company 5 debtors and stuff like that, because the payments and everything was collected through BATCC and not by company number 5 anymore, right? So that was part of the ruling, and the other part of the ruling was actually this org chart, which you can see where they talk about British American Tobacco at the top, the PLC, and the companies in between. And you can see in the bottom left they talk about BATCC, FOF, and who its partners were. And I think that this is what we refer to in the Dutch case as company number 4. The court itself has decided, so we now know that it's BATCC, not VOF anymore, company number 4, and we know that country number 2 is Belgium. And the court goes on and it says the circumstances for determining the risk for the company 10 insurance premium and the company 4 factoring service fee were comparable. So the taxpayer said, that these two transactions were not comparable at all. See what our company number 7 and company 11 said about this in their transfer pricing studies. And the court said, well, I mean, okay, the one was a credit insurance, the other one was factoring, but at the end of the day, in practice, both covered the debtor's risk for factor client number 5 and the insurance premium paid to company number 10. Therefore, the risks that it covered were comparable to those for the risks covered by company number 4 or BATCC. And the court goes on to say, even though Enelco's 5 total debtors portfolio may have exceeded euro 660 million, the actual risk of company number 4 was much lower, because you will not you will be a very strange business if none of your debtors pay, right? So the fact that your total debtors outstanding was 660 million doesn't mean that was a total risk for company number 4. And this figure comes into play because part of the taxpayers' defense apparently was, because of this figure of 660, BATCC needed a huge equity, and BATCC was allowed to charge the price for that equity to factor client number 5, and that is this difference between the 438,000 paid to company number 10 and the 2.5 million paid to company number 4. But the court does not buy that because it says that's simply not the case. It also goes on to say a third party will not insure a risk for euro 2.5 million with company number 4 if it can insure the same risk for 0.4 million with company number 10, and that is common sense. So it says, considering that Enelco 5 contracted with both company number 4 and company number 10, it is assumed that it knew that it was paying too much to company number 4, right? And what the tax inspector did in Holland and what the court followed is said, this 8% effectively, which is taxable in Belgium of the total factoring fee paid. In other words, 8% of the 2.5 million or 20%, depending on how you read this. Actually, it's 8%, and I'll explain why in a moment. Only that part is deductible in Holland, and the reason why I'm saying 8% is because the administration fee that was paid to company number 4, which probably brought us from the 8% to the 20%, that was another 1.2 million, which was added on top of the 2.5 million, right? So as far as the 2.5 million was concerned, which was a risk premium only, only 8% of that, the way I understand the ruling, was taxable in Belgium and therefore deductible in the Netherlands. There was one further issue, and that was there was also a penalty levied on the Dutch companies and on the tax consolidated group, because they said that the tax was undermined willingly and knowingly, right? So the court says the tax authorities levied 477,000 euros in penalties on the Dutch bad taxpayers for knowingly applying a wrong TP methods for factoring fees. And then the taxpayers said, but this is not true. I mean, we had advice from company number 7 and from company 11 that these were not comparables, and therefore we were doing the right thing. We had a defensible position, right? But the court goes on to say, well, Dutch law only requires the taxpayer awareness of a significant chance of underpayment, right? So you must not be aware of underpayment. You must be aware that there is a significant chance that the tax that you paid is less than what is due, and that this can even be the case when the taxpayer has specialist advice, because the taxpayer's own expertise and own experience must be considered as well. And since company number 5 knew all the conditions for the payment to company number 10 and to company number 4, to BATCC, and knew that the risks were the same, it could have expected that this was an overpayment. But the penalty of 477,000 euros was then reduced by 20,000 euros because the case took more than 2 years, and this is effectively a criminal procedure. And therefore you get human rights laws kicking in, saying that if your prosecution is more than 2 years, then or certain aspects of it is, then there's a reduction for all of this taking too long. So this is what I wanted to discuss with you. I think it is an interesting case. I think there are lessons to be learned from it, in particular that you cannot blindly trust what is written by your advisor, but at least in Holland, the taxpayer's own knowledge and experience is taken into consideration as well. And the second, I think, strong moral here is we need to be very careful with rejecting our internal comparables. I hope you enjoyed this case. I will discuss the rest of the issues with you next week, and those will deal with guarantee fees and excessive interest payments. I look forward to seeing you then again. Bye for now.